So let me finish with something talking about returns. Now, Rob was talking about different asset classes and what the options and potential is. The Economist does this study. They go to a lot of very top investors around the world, pension funds, and they say, okay, let's take a look at what the expected returns are going to be in a balanced portfolio looking ahead for the next 10 years. And they went all the way back to 1900, taking a look at how a balanced portfolio would have performed in the next 10 years. The graph is a bit confusing, but here's the important part. As of today, they would say that the average return on a balanced portfolio for the next decade will be 2% a year net of inflation. And that's a pretty low rate of return. Why? Because basically most asset classes are priced for perfection. So the question is, how do you get a 4% real rate of return when the underlying asset classes are so relatively expensive? So when we take a look at why this might be the case, take a look at these returns. This is in the last 30 years. The average return on equities and bonds has been way above their long-term average. So there's going to be a natural reversion to the mean on asset classes. So if we're just simply buying a basic asset class, we buy it, we hold it, we don't do anything with it, we don't add any value, we don't come up with any strategies that change the outcomes, we have a good chance of getting some pretty mediocre results. And most market makers, including Michael Sabia, who heads the Caisse de Dépôt in Quebec, and most of the pension managers feel the same way. So the drivers are aging populations, reduced productivity growth because of that to some degree, rising interest rates at some level, lower profit margins, and higher taxes, a combination of things that make it difficult to get higher returns. You sure you don't want that drink now? Or just okay. All right, you would like two, Thelma? No problem, we'll get those for you. Another issue to look at is what are the chances of rates of return based on the valuation of a market? So Robert Shiller, who wrote Irrational Exuberance, both about markets, stock markets, and about housing, and was right both times, has an index that he used, which averages return, price-earnings ratios for the previous 10 years. And then he looks at what would the forward rate of return be in the stock market depending on the price-earnings ratio you start at. So in this case, when we looked at this graph originally, the stock market was trading between 19 and 22, and the future returns were expected to be around 4%. This is net of inflation, mind you, right, 4.5%. However, I just went and took a look at the latest version of his index, and it's no longer at 21 to 22, it is 29. And that's the future rate of return, which is less than 2% a year. So again, what he's saying is statistically, we're in a position where it's going to be hard to get real rates of return because of the relative cost of buying of each asset class that we're in, stocks not being excluded from that. Which brings us to passive versus active investing, and Rob touched on that briefly. There's tons of information about passive investing, ETFs, low-cost investing as strategies that outperform individuals. And when you look at the first information, if you Google this, you'll get 146,000 responses. So if you want to spend a lot of time researching this, there's no problem. You can spend all the time you want researching this stuff. One of the things that we did a few years ago was compared ETFs to the average fund manager in Canada investing in 4 different categories: stocks, bonds, the S&P 500, and the global index called the MSCI. And in each case, ETFs, in every single case, were first quartile over 10 years. So the first comments and the way the media explains ETFs are better than the average fund manager, they are 100% correct. The question really is that the whole story? And as we'll see, it's not the whole story. So there's another analysis that was done by a couple of guys from Yale at the time when it was updated a few years ago in 2013, which took a look at performance of fund managers who were either active or passive. That is, by active, they meant fund managers that were truly active, being very involved in the selection, basically what we would call stock pickers. And they focused on positions. For example, Oakmark Select is one of the funds they looked at that only has 20 positions, but it's being compared to the S&P 500 with 500 positions. So they're not trying to actually emulate the benchmark. Their job is just trying to get a good return for clients. They're not trying to be the S&P 500. So the question was, how did they do? Well, on average, net of fees, all of these managers that were really active managers beat the index over a 20-year period by 1.25% a year, which is quite significant. The rest of the managers, which is 80% of them, were 1% a year behind the index. Why? Because essentially they were investing exactly the same as the index minus their fee. So of course they were 1% behind, because they're going to get the index return minus whatever they charge. So the question is, can you find active investing? So we took a look. Recently, there was an article in the Globe and Mail, Globe Investor, by John Heinzel. And we like, as you know, high cash flow generating vehicles. So he went through 6 exchange-traded funds that all have really good high yields, that invest in common shares, and in many cases have dividend growth. So the actual dividends are growing every year, and low fees. The average return of all 6 of these funds for the previous 5 years was 6.9% net of fees, and the average MER of these funds was 0.54%. We have 2 funds that focus on high cash flow investing using dividends and also, as you know, covered writing using puts and options and calls. And those 2 funds average 11.7%, and basically they have exactly the same MER. The difference is that they are actively invested. They're typically, in each case, each of these funds only has about 30, 35 positions. It doesn't have 300 or 400 positions. It's not trying to emulate the market itself. So we decided to take all of the funds that we have and find the closest exchange-traded fund we could that measures that would, let's say, compete with it, and look at results for the last 5 years using just a very simple average. So the average of all the ETFs for all 14 of the categories we looked at was 4.03%. The average of the funds that we are managing on your behalf was 6.84. But the most important number from our perspective, because we look at this as a behavioral finance issue, is what did the client's average return equal? Well, that was 7.73. So they earned a higher return than the marketplace. And they also earned a higher return than the underlying funds that they were in. So on the left-hand side, the Dalbar effect means the average investor is getting a lower return when they're doing it themselves in ETFs, because they're not likely to match the basic return of the ETF. On the right-hand side, this is what happens if you have disciplined rebalancing and a good structured asset allocation model. So from our perspective, the formulas that we use are to try to concentrate people in terms of making sure that they're likely to get the best outcomes by using the best probabilities. So just to summarize, the absent superpower is making a strong case for the U.S. being an extremely powerful economic force for the next significant number of decades. Know thyself and behave well really makes a difference to results and performance. And finally, that you can get very good results with low-cost active investment performance. And our argument and our belief is that's significantly better than just a passive market-based approach. So with that, our formal comments are finished. I want to thank you all for coming.